Hello everyone and welcome to the video for the taxable account 2023 November. So this is my chance to get these all caught up. Video is being made about 10 days after the close of the month of November. So everything that you're about to see, with the exception of the gain loss table, which is going to be current to the 8th when the market closed, is going to be within the last 10 days. So pretty excited about that. But let's jump into the numbers. So as always, I'm not a financial advisor and I don't claim to be one. Article represents my personal views and I'm not giving any specific or general advice. And this does not reflect the views or opinions of my employer. I have a beneficial position in a number of shares and I have those listed on the screen. And as always, this is a real portfolio with actual shares being traded. So it's not a practice portfolio or play money. This is actual things that are taking place, and I try to provide enough screenshots to make sure that that is apparent. But I have a relationship with John Jane, goes back quite a ways. Some years ago, they had a financial advisor that was not doing what I think was necessarily in their best interest. And after talking with John Jane about it, they decided that they wanted to take control of their finances on their own. So that's something that I offered to help them with, and basically in exchange for me helping them, I just asked that I be able to present it anonymously so that way other people can see things in action, because I know a lot of times there's going to be folks that talk about retirement and things like that, and they always like to show things when it's good and then don't necessarily show things when it's bad. My goal is to show you the good, the bad, the ugly, because it's a better way to understand your retirement rather than just getting panicked every time you see something negative happen, or maybe something that doesn't feel like it's a good thing. So my goal is to get people feeling like it's something that they can manage themselves if they want to. So just trying to give them the tools to be able to do that with some confidence. And then as far as background goes, John and Jane are both retired. John retired in 2018, Jane retired 2021. They both collect Social Security, and from their accounts, the taxable account currently they take $1,700 a month. That was increased from $1,000 a month in 2022, and it'll probably increase again because of as you'll see in this video, that the income continues to increase what's being generated in that account. And then for John, coming from his traditional IRA, drawing money out of it because his RMD is coming up, and so he's going to have to take the money whether he likes to do it or not. And I usually cover that a little bit more in depth in his articles. But outside of what I help him with, they do have some other investments, but it's mainly low risk, CDs, things like that. And then they also have no monthly debt or payments other than your basic phone bills and utilities and things like that. So John and Jane have made it very easy on me to be able to help them because they can live off of the bare minimum amount if they want to. So in the taxable account, it generated just under $2,100 of dividends in the month of November, and that compares with about $1,950 in November of 2022. And then for the balances in the account, it's down about just under $10,000 year over year. And one thing that I think is important, and I'll show on a different slide, is that when you add back in the money that they've drawn out from income, the account balance would be sitting at a positive compared to where it currently is if they were choosing to leave that money in there. So anyway, I find that this is pretty good performance, especially with regard to all the changes that have happened over the last year. And the annualized cost basis across their portfolio is 5.61%. And that just means that as a whole, they're generating on all the money that they have in their taxable account, 5.61% is essentially the yield that they're receiving across all their investments. But there's two companies that announced increases in November. November is a pretty light month for that, and no companies decreased their payouts during the month of November. So Energy Transfer did a 0.8% increase. Their increases have slowed down since they got the distribution back up to where it was in November of 2020 when it was cut. So that's good news, that Energy Transfer is basically where offering the same level of distribution that it was back when it had to cut it due to changes in the economy with COVID, with energy prices, and all of that. And then for Verizon, they provided a increase that's very similar. Their 5-year average is right around 2%. So 1.9% year over year is in line with that. And this is the 19th year of a consecutive increase that Verizon has done. The value for Verizon is not so much in the growth of the dividend as much as it is that it's currently offering a fairly compelling yield in comparison to what it normally has in the past. So in that sense, if you're buying Verizon shares, the value is more going to be the fact that the yield is currently high, and not because if that yield starts to go down because the prices start or the stock price starts to improve, that's going to diminish the value proposition because it's going to drop the yield. And then for Energy Transfer, this is the cost basis, and as you can see, there's still some shares that were purchased back in 2018 and 2019 that are still sitting at a small loss. But we bought, at the early phase of COVID, we added 100 shares, so we do have a number of shares that are in that position that are doing quite well in terms of their return. And now that the distribution's been moved back up, and the company seems to be doing well in terms of executing, that's something that I expect to see that the stock price is going to continue to rise. I don't know when it's going to get back up into the $14-15 a share range necessarily, but realistically, I would say it's on the right path. So something I'm also going to start doing is including how much in dividend income John and Jane have received since, and this always is 3 years ago because that's the farthest back Schwab will let me go. And then also at the current dividend rate and the share count that they have, about $1,500 of John and Jane's income from the taxable account comes from Energy Transfer. So it does provide a pretty outsized portion of their income in the taxable account. And then for Verizon, you can see we're about $2,200 of dividends over the last 3 years. And then because of the shares that we've purchased recently, if we were to add together, it'd be, I think it's right around $2,550 of dividend income that comes from Verizon over the same 3-year period. So that's another interesting way to look at this, is just to say that it's generating more, but we also know that it's not because of the increases, because 2% increases aren't going to be enough to move the needle. It requires purchasing additional shares to really move that needle. And as you can see in the last 2 years, that's when the bulk of additional shares have been added, compared to when the position was originally established. And then for November trades on here, so Eaton Vance tax advantaged account, so went ahead and added there, since the price is sitting not at 52-week lows, but it's still sitting at an attractive price point, and we needed to put some money into an investment. And then for Washington Trust Bancorp, we bought here at just under $26 a share, and the stock price has since moved up, so it was a good time to buy. But we do have a cost basis that is on the higher side, because this is what happened to the stock price after the fallout after Silicon Valley Bank, and some of the other things that have been going on with the banking sector. I still like Washington Trust, but we wanted to add some shares here. And again, like I always do, as that stock price starts to move back up, we'll look at a certain price, trimming back some of the higher cost shares. EPD is going to be the counterpart to Energy Transfer, on a much smaller scale, but still a very large pipeline network. So with EPD, that's also performed quite well, and so that's why we added another 100 shares here. We are getting close to the higher cost portion of the position, so as this moves into the $28 share range, if it does, that's when we're going to look at selling off some of the higher cost shares in favor of leaving these lower cost shares. Net lease office properties, this is the spin-off from WP Carey. I mentioned in the previous videos, we went ahead and sold it because, frankly, for 12 shares and the asset base that they have, I'm just not really interested. We could have probably held on a little bit longer, and the share price is now at $19.50. So yes, could we have made some more money off of it? Sure, but I'm just not interested in having to learn a whole new company that we haven't been keeping track of. And then for APD, we went ahead and bought shares here. I can't remember what it was exactly that caused the drop in share price, but around $260 a share is definitely something that I would find attractive as far as an entry point goes, because APD is it's a solid company. So anyway, I like it. And then as far as Apple goes, this is the sale that I mentioned in the previous video, where we sold off 10 shares, and that is the large gains that you'll see here, because we have an extremely low cost basis when it comes to the Apple shares. So so basically we offset that, and then that way when you look at the year-to-date gain loss here, you can see where we're still sitting at a small loss, so we have more shares that'll probably need to be sold here that are sitting at a gain, and it's not so much that we don't want to have a loss, it's that's the whole point, is to utilize your losses in order to offset your gains, in order to avoid taxable consequences with it. So but yeah, this gain loss table is good through 12/9, so it's not just through the end of the month of November. And then for the year-over-year comparison, we reduced exposure to Arbor Realty. We'll look for a more attractive entry point, but being the sector that they're in and the extremely low cost basis that we have on the remaining shares now, I'm fine with the risk that position presents in the event that we see the market start to head south, especially when it comes to the type of loans that they originate, which are like bridge loans and things like that. And then for Clorox, we eliminated it, so you'll see where Clorox here doesn't exist in 2023. Clorox has been on the struggle bus, and basically a once great holding has now had way too much volatility, and it just got to a point where after I believe it was their computers that like their system got hacked. It was prior to that we had sold it, that I was reassured that was a good decision, and we just don't need to be dealing with Clorox anymore, at least not at this point in time. We did increase, as mentioned, the size in APD and then Energy Transfer, and so that's why you see in part higher dividends coming from both of those companies. And then now we have CD income from two $15,000 CDs that's now reporting, both are reporting, and so that contributed an extra $65 ish for the month of November. And then for the full year comparison, you can see that in the month of October, the whole portfolio was looking like it was going to be up 4% in 2023 compared to 2022. And then after November, with the increases that we saw there, it's now looking like it's going to be up about 5% year over year. And remember, this is including this $2,010.90. So if this number goes down, then we're going to see this increase year over year go down. But if this number goes up, then we'll see the increase year over year potentially go up as well. So I think that's most of what I had to say with with the taxable account on that screen. As far as the balance goes, already mentioned this, that if we're down about $10,000 year over year, but on the screen that shows the draws that have been taken out of the account, I have some math to show kind of where things would be if we added it back in. But overall too, when we look at the average balance, so this is taking the month-end statements for 2023. Right now we're sitting at an average just under 530,000, whereas in 2022 we saw some wilder swings that caused that average balance to be lower. So 2023, for all the volatility that we've seen, it's actually been less volatile than what we saw in 2022. And then for the 6-year income piece here, you can see that we had a little bit of a setback in 2020 in terms of the income in November, and then it's since continued to grow. But this also shows where we're estimating the full year income increases to be. But yeah, I'm pretty happy with a 5% increase year over year, especially considering the circumstances that we've had with all the changes in the market. And then for the cash balance comparison, this is down just slightly from the previous month and quite a bit from the one prior to that. But you have to remember that we did purchase a $15,000 CD during this time. And so these numbers do not reflect, even though CDs I would consider to be much more liquid than just stocks or anything else like that. But if we added that $30,000 back into here, that's essentially what the cash balance would be at, would be about $54,000. So we are holding more money in cash, even though it shows that the average balance is down. That additional 30,000 would definitely show that it's headed the other direction. It's heading higher. And the other thing to remember about those cash balances is that in the previous months in 2019, 2020, and 2021, there were no draws being taken out of this account. All the money was being reinvested as well. So that contributed to having higher average cash balances. And then for the unrealized gain loss comparison, you can see that it was a huge swing the other direction, $25,000 from the end of the month of October to the end of the month of November. And this number has still gone up since then, now sitting at market close on December 8th. So as you can see here, the big thing is that people who choose to sell when things get bad are the ones that are going to lock in their losses. So I like to look back to like COVID, and at one point the taxable account was about $90,000 in the red, and sure, there may be times that warrant selling, or there may be certain stocks that warrant selling, but if you're purchasing the right stocks and you're paying attention to your investments and you're being realistic about what your risk tolerance is, we actually used 2020 to add a bunch of shares, and that's where you just see from the gain losses here in 2018 and 2019, you see the gain loss absolutely explode, and that's because we deployed a lot of money when people were getting out of the market or when people were panicked in the market. So even though you see all this volatility in 2023, I mean, at the low point, it was at 76,000, and at the high point, it was about 131,000. So that's about a $45,000 swing. Oh wait, no, that's way more than that. That's 25, 35. So that's like an almost like $55,000 swing. So $55,000, people might look at that and kind of panic a little bit. But the idea is that as long as you keep holding, and you have good stocks, they are going to bounce back. Now, that doesn't mean that you can just always hold stocks. And that's part of the reason why you see us moving more towards CDs and things like that, because that's going to be part of what helps us balance out the risk with the portfolio. But point being, I'm not concerned as much about the gain loss, because as long as that company is in business and doing what it's supposed to be doing, then that's what makes it a good investment, even if the market isn't favoring it at the time. And then for withdrawals, you can see that in 2022 we had $12,000 at $1,000 a month, and right now there's been a total of $18,700 at $1,700 a month, with December still waiting. So if for the full year to date 2023, the amount will ultimately be $8,400 more that John and Jane have taken as a distribution from their account than what it was in 2022. So they've taken quite a bit more money out of their account. But also because their income has continued to go up. Right now it's looking at close to about $1,900 a month. I'll probably encourage them to bump this up to $1,800 if they'd like to. If they don't want to, then we'll leave it at $1,700, but I leave that choice, completely up to them, because they're the ones that actually tell me what they want done. And then also, I think it's interesting to think about, if you took all $20,400, so let's say John and Jane said, nope, we'll take the $20,400, but we're not going to spend a penny of it. We're going to take it and put it into a CD yielding 5%. That would generate an additional $120 a month for about $1,440 of annual income, just from the dividends or the income that was taken from their account. So I think that's a really interesting way to look at this, is that you can take your earnings, reinvest those earnings, and those earnings reinvested, even at a reasonable rate CD that's easily found right now, can generate a lot more monthly income. And you compound that over time, and that it definitely goes a long way. And then as far as the gain loss goes, you can see in the taxable account, most things are in the green. It helps explain why it's currently sitting as high as it is when in terms of the current gain loss. Because as of market close on December 8th, it was at $112,000, so even higher than where it was at the end of November. And this table, I just think it's super important, because you can look and see what size each position represents in the portfolio, based on the market value of that investment, and also the amount of dividend income that each one provides. And then also shows you that, things like Eaton Vance fund, this is the one that I mentioned in the transaction history that we purchased additional shares of, that, it's yielding 8.6%. And yes, it's sitting at a loss, but again, as long as it's a company that's producing dividends, and sorry, I say company, but it's not a company, it's a closed-end fund. But as a closed-end fund, it's going to ebb and flow. And in this case, it's currently sitting at a loss, but as long as it's continuing to produce a solid yield, that's the thing that we're most concerned about seeing. And for the conclusion this time, there's been a number of news reports that go so far as to say that inflation is cooling off. And that's part of the reason why the market's been on a 6-week winning streak. I'm just not convinced, especially in the face of what I see in my industry, which is record delinquencies, repossessions, and basically the full-blown stalling of the auto market. Another thing too is that when it comes to them talking about inflation, usually they're just taking the large number that encompasses everything. And the better question to ask is, what sectors are seeing increased inflation or reduced inflation? And one of the interesting numbers that I saw, but I couldn't remember where I saw the image from, was talking about how basically medical costs have gone down. And I thought that was pretty surprising, because that's usually the one that they say always continues to go up. But what I think is happening is that they're saying medical costs are going down. I think it's really that people are choosing less coverage on their medical options. So their cost of insurance is going down, in part because they're basically being saddled with more of the cost that they would have to pay out of pocket. So whether or not that's an improvement, I would say it's definitely not. But that number factors into the inflation number. Same thing with the oil and gas sector. We've seen the price of fuel come down a fair amount. And that's going to be something that also carries a heavy weight on that inflation index. So, long story short, I'm not convinced, and I'm preparing for things to be a lot worse than what they're talking about. But they've been bringing back the term soft landing, which I find kind of irritating. The soft landing makes it sound so pleasant, because it's just a fancy way that the Fed, people saying that the Fed was able to, raise interest rates enough, but that they basically got their guesses right about how much inflation or the rates needed to be raised without triggering a recession. And what I really find interesting about this concept is that triggering a recession has become a really negative idea. And, just to give a really good example, let's say interest rates do start coming down, and now all of a sudden you see housing boom again, you see people wanting to buy stuff. The problem that I have with that is that our younger generation is getting just like completely screwed in terms of housing affordability. So yes, interest rates might drop down to 4%, but what we really need is for interest rates to hold high long enough for people to go, oh, well, this home that I was paying $500,000 for is really actually only worth $300,000. But the thing is that the longer we continue to have low interest rates, and sorry, the way I worded that's probably not the best, but basically if we were to go back to low interest rates, it's basically the middle finger to our younger generations that are hoping one day to be able to buy a home, and saying pretty much, yeah, the only way you're going to be able to afford it is if we lower interest rates enough. So really what we need to see is those interest rates remain high enough, that the homeowners and the builders go, okay, well, we can't be selling these houses for $500,000 anymore, or we need to figure out a way to make the permitting process easier, right? It's the regulation that's associated with building these homes. So we need to see housing prices go down, because housing prices can't keep going up forever, because if they do, that's going to basically be 2008 all over again, just with a little bit more protection from Fannie Mae and the reinsurance companies. So rant over, but I hate the term soft landing. I would rather see us experience a mild recession, than for us to say, we didn't experience any pain at all. Because us experiencing no pain at all means that someone's experiencing pain, it's just not me. So I'm fine with the idea that it's, we're going to have to see less raises at work. We're going to have to see more strict underwriting. I don't like hearing or thinking about the fact that people are losing their jobs, but it's basically that a recession is the chance for the systems that we use to reorganize themselves in terms of what value they provide. And so I would rather us stop talking about this soft landing and make sure that we're doing right by the people that are following us up the ladder of wanting to have families and things like that, because they're the ones that are going to get disgruntled if interest rates move back lower too quickly. So environment's still too optimistic, and this is just part of the reason why we're continuing to put money in CDs. We're selectively investing into funds, so like EVT. Part of the reason for doing that one is that it's going to be diversified. It's going to produce a solid dividend yield, and the fund has been in existence for a very long time, going back to, I believe it's like 2004. So anyway, that is everything that I had to say on this one. Let me know if you guys have any questions, if I need to explain anything a little bit more clearly. I'm trying to keep these videos around 30 minutes or less, which I'm right on target for. So I'm sometimes skipping over things and not explaining them as much, maybe. But yeah, I'm happy to answer any comments, and thanks everyone for taking the time to watch, and have a great day.